Welcome back to FT Markets. One of the big topics in emerging markets this year has been how the low oil price is affecting the economies of the Middle East. And with me here today to talk about this and other topics is Florence Eid-Oakden, the chief economist of Arabia Monitor, a research and strategy company focused on the Arab economies. Welcome, Florence.
Thank you.
To start with, could you just give me a sense of how you feel the low oil price is affecting the economies of the Gulf in its main manifestations?
Well, as you know, those economies remain undiversified and highly dependent on oil. So the big question when oil drops, and we've seen this before in the 1980s, it dropped to $9 a barrel, is how will these economies survive? What is the fiscal impact? And how will they survive? And where, most importantly, is the price of oil compared with their break-even price for the budget for a given year?
And if we look at a chart here, I think we've got some break-even points for each of the different countries.
So if you take a look, for example, at Saudi Arabia, very important economy in the country, in the region, the price of oil assumed in the budget is in the 90s. And the price of oil today is much below that if you look at this vertical line coming through on the current oil price. And so for all of the countries, Bahrain, Saudi Arabia, UAE, down to Kuwait, the budget break-even price is higher than the current oil price. Now, what does that mean? It has implications with respect to what they can spend, and it also has implications as to how much they will be dipping into sovereign savings for the current year.
And so if we look then at the impact in the next chart on how this lower oil price is affecting these countries, we can see some pretty dramatic movements from 2014, which is the red bars, to 2015, the blue ones.
Absolutely. So if you take a look at all the countries that had a red bar in 2014, these were surpluses in 2014 above zero. And in 2014, practically all of them are firmly in deficit. And if you look at the gold line below that, that's the GCC average for fiscal balances for 2015. And that is around 7%. And also, if you look at the entire MENA region, obviously the oil importers benefit from lower oil prices, but they've been carrying deficits for a few years, and therefore the deficit is still close to 8% on average across the MENA region. Now, what does this mean for some of these economies? It's really a function of their savings. For example, despite the lower oil prices and the break-even price much above the price of oil, Saudi Arabia passed a budget just a month ago that is higher than the budget was for 2014 by about 0.6%. Now, what does that imply? Well, if you look at the savings of Saudi Arabia, the deficit of this year's budget, it can be covered from the government account reserve savings. That's different from the central bank's foreign exchange savings. From the government account, the deficit can be covered in multiples for 5 years to come. So the cushion is there in terms of sovereign savings and government accounts in these sorts of economies. The question really is what happens to liquidity in the economy if oil prices decline and projects start to get cancelled.
So what does this mean for the rest of the world? I mean, ultimately it means that the Gulf countries have less money. Will there be fewer petrodollars flowing to Europe, America, and other places?
So it's all a function of how long the low oil price environment lasts for. At an initial stage, say they have a portfolio allocation out of a given sovereign wealth fund from the Arab countries of, say, 30% allocated to Europe. Now, say the oil price remains low for another year. That 30% of a smaller pot of additional funds to invest abroad would probably remain more or less constant. Now, what happens if the oil price remains low for a longer period of time is a different set of questions, really. It has to do with a trade-off between risk and return, different parts of the world, growth opportunities in Asia, and what that offers. But I would say, as an initial stance, the portfolio allocations wouldn't shift very much, right, but in the long term they could.
Thank you very much. So there we have it. It looks as if the fiscal strains that are being experienced by the countries in the Gulf could have an impact on petrodollar flows around the world, particularly in places like Europe.